that's what's top of mind for everybody, right? Is interest rates. Well, these three things are what the Fed is looking at as it relates to interest rates. And so let me explain quickly how they relate to one another. So the top line there that says real GDP, as long as that number is positive, and especially if it's over 1 or 2%, we believe that the Fed is saying, hey, the economy is still doing pretty well. And so it's a little counterintuitive, but if you think about what that means for interest rates, that means that they believe that the Fed believes, hey, in spite of raising rates, the economy is continuing to do well. So it's easy to rationalize, let's continue to raise rates. And you might say, well, why would they do that? They just want to crush GDP and wreck the economy? No, what they want to affect is that middle line. So CPI is actually, every Fed move that you're watching is mostly related to CPI in response to CPI, but they're watching GDP and unemployment as they do that. So as long as CPI is 3% plus, they made it real clear that they would like to see that more in that 2 to 3% range. And we think that they might want to see it there for maybe a couple of quarters. It may not be immediate. Here's the gist of it all. GDP remains solid. Unemployment remains low, but CPI remains high. The Fed is more than likely, in our opinion, to remain in a higher for longer interest rate environment. That's the gist of, if you want to know what's at the top of our mind for the economy, that's it. It's those three things, because that's what the Fed cares about. And this interest rate environment is what has been influencing financial markets more than anything, we believe. If you look on the far right, you'll see where we're at right now. So that orange at the bottom right there represents a bear market cycle, which we're currently in. You can see a teeny tiny little blip there in 2020, right? A lot of people like to say, well, we haven't seen a bear market in years. Well, we're living in one now. We did see one in 2020, but it was short-lived. And so some of the injection of capital into the system, we believe the Fed absolutely needed to take action to keep markets orderly with everything that was going on. At the same time, there towards the end, we believe it might have got a little overdone. And so by doing that, the money supply got way too hefty. And so the money supply increase is going to cause inflation. And the only way to do something about that is to decrease the money supply. So having said that, if you look at that little run we had after 2020, well, basically, hey, we artificially kind of fixed some of it. So we got to give some of that back and work out the mess. So that's what we believe we're actually experiencing right now. And so we like to think of it as pruning a tree. Boy, I've got a pear tree at my house, and I wish that, that thing would just grow big and big and big and have pears on it every year. But there's years that we got to prune that thing back, and it doesn't do quite as good, but then it's almost always followed by a really, really great crop, right? So the same can be said for markets. So a couple of things I'll point out to you here. We often see really strong performance after a significant pullback, and we've experienced that significant pullback last year without a doubt. And as a reminder, we're still not out. You can see we're still below that. We're in the orange still. So that just from a purely statistical standpoint, that's reassuring.
Inflation, something that we've spent just an inordinate amount of time talking about, more than I'd say the past 2 years. We've talked about that more than any time in my career. Obviously, here recently we've seen that spike upward after 2020, but if you back up, 10 years before that, relatively muted period, and haven't seen that jump upwards in inflation really since the 80s and back into the 70s. I'm sure many can remember back to then. In order to measure some of the inflation, you can see there's the CPI and then the core CPI, and just the difference there is carving out food and energy. Those components of inflation a little more volatile. Really, overall, main takeaway from this slide is the rate of inflation is moving in the right direction. The Fed, as Brandon alluded to, that's something that we've kept a really close eye on, because they've been trying to combat everything that we talked about on some of the previous slides. What this chart is showing is just that lower limit of the Fed funds rate. And when I say lower limit, they're always saying, they're going to keep it between 5 and 5.25%, or 4.75 and 5%. So that lower range there, that solid line is kind of where that lower limit has been, backing up to about 2003 or so. So you can see where it went before the 08-09 financial crisis, and then that quick backtrack, saw that again slowly stepping up 2016 through 2018, and then a quick reversal. But here we are with really the fastest rate hikes, I believe, in history here over the past 18 months or so. Currently around that 5.25%, and then we have that dotted line showing what the FOMC, the Federal Open Markets Committee participants, kind of their median assessments looking forward based on economic projections. The Fed intends to keep rates somewhat high to help reel in some of that inflationary pressure. And I guess the one positive from the Fed's raising rates has been, what we've seen on what things are yielding, cash equivalents. We did, I guess, just to backtrack for a second, we did, talked about the stock market last year with the Fed raising rates. That was not only impactful to the market, but also to just the fixed income markets overall. Hopefully all that's behind us, and looking out now, we'll see some bonds performing as they should. But just getting back to some of the positive effects of the Fed rate increases, cash equivalents, CDs, as Brandon mentioned earlier, what they're paying out, generating income again from relatively conservative or safer investments that we haven't seen since the financial crisis back in 08-09. You can see that shaded region there on the chart is almost non-existent from 2010 here until just recently. Interesting okay, we've got great yields, we've got CDs, 12, 13 months yielding 5%, but how is inflation affecting that? Even relatively muted inflation that we saw over the past decade, it's still impacting that purchasing power, or as we call it, purchasing power risk. We still recommend holding a cash reserve, an emergency fund, placing it in an insured account, an FDIC insured account, to get those attractive yields. If you do have excess cash out there, it might be worthwhile to review your financial plan, determine when or if it's appropriate to put some of that to work. As Brandon mentioned, and I just alluded to with that dotted line for the Fed, these lucrative yields won't really last forever. Might stay somewhat elevated at these levels we're at now, but could come down in the years to come. With that, I'll turn it back over to Brandon to discuss some on interest rates, bonds, and this more attractive environment that we're in now for fixed income.
Yeah, thank you, Michael. Yeah, and I'll just touch on this slide too. I always say, CDs are a great tool to have in the toolkit, but they are not at all a silver bullet. We just got done sharing with you that part of the reason we have so much inflation is because just the excess money supply. So what is excess money supply? Well, that means people have cash, corporations, individuals, institutions. And so if you look at 2008, that was a credit crunch, a liquidity crisis, and there wasn't enough cash to buffer those higher rates. Well, right now we feel like we're in a much different period from that standpoint. And also, if you look at what really caused that Lehman Brothers debacle, when we look at how those mortgages were packaged, borrowing has gotten much tighter. It is much more difficult. That was the biggest response from a regulatory standpoint post 2008, 2009 was lending standards. So like we said, history doesn't always repeat itself. Sometimes it rhymes. That's one thing that we're not necessarily saying, hey, we're expecting that to rhyme. We're looking at that in the perspective of how is right now, on the surface level, these times look real similar, but how is it different? Well, a surplus of cash and stronger lending standards does make it certainly feel different. Let's talk a little bit about historical interest rates. This is a fun slide. you can see, here we are, we were down at the bottom of that trough in 2020, and now rates have come back up, and we're just, it feels like rates are hyperbolic and the highest they've ever been. Well, as Michael alluded to, many of you that were around for that Carter Reagan period there, late 70s, early 80s. I can't tell you how many times I've heard clients share with us their first house was bought at a 16% interest rate, or whatever the case may be. So most definitely we've been in higher interest rate environments. So you may look at that and say, well, how, what's the deal then? If interest rates have been this high before, just get over it, live with it, not a big deal. Well, Michael alluded to how quickly rates have moved. You can see that spike was just astronomical. But also, when folks were buying homes at 14, 15% interest rates, they weren't paying $700,000 or $800,000 for a 2,000 square foot home. And we're seeing that, in places like Texas. So I know one thing for certain, if you look at history, what comes up usually comes down at some point, right? No chart is linear. And so our thought is that rates and home prices can move upward together for only so long. So that's one thing that we're watching, is for rates to stay this high, home prices will have to soften, and or the latter, if home prices remain on the upward trend, then we would expect rates to come down. Those two cannot live in harmony forever. So you can see that there's been a great trend downward. As Michael alluded to, we feel like we're probably closer to the Federal Reserve's terminal rate, and but maybe they might have to hold just a little bit longer to ensure that some of those slides that we were sharing, CPI, PPI, remember, they're driving with a rear view mirror. One thing to note is that bonds, which I know got picked on a lot last year, as rates moved up, bond prices moved down and created negative returns. Core bonds tend to do pretty well during Fed pauses. So think of it this way. We don't have to see rates, and we may not see rates like we saw 2 years ago when we heard about folks locking in sub 3% mortgage rates. We may not get back to that place, but just a pause in rates could be a very, very good thing for fixed income markets. The real risk is deflation. We're kind of in the camp that if the Fed keeps raising rates, this will go from an inflation concern quickly to a deflation concern, which actually is very bad for the economy. So we don't think the Fed knows that. So a pause in an eventual, like we said, markets are expecting maybe first quarter next year, second quarter next year, a decrease in rates. We definitely do not think that's out of the cards.